The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
It's Friday, everybody, and what a packed show and a packed day because it's payroll day as well. So you're watching Squawkbox with Arabella Mayday and myself, Steve Sedgwick, and these are your headlines. So China's exports, well, good news there. They surged more than 7.5% in May, but there is a balancing act on the imports. They were slower than expected in terms of growth, pointing to more signs of weakness potentially in domestic demand. Well, the most flagged rate cut in the history of rate cuts. There you go, I said it. The ECB does actually cut rates for the first time since 2019. But was it a hawkish cut? Yes, that old chestnut. Persistent price pressures in the Eurozone have markets pricing just one more cut this year, whilst President Christine Lagarde refuses to commit to further easing.
I cannot confirm that it is the dialing process that is underway. There's a strong likelihood, but it will be data dependent.
And exit polls in the Netherlands show the Labour Green Left coalition in the lead, securing 8 seats in Brussels, while Geert Wilders' anti-immigration PVV makes strong gains, just 1 seat behind. And Gamestop shares surge in extended trade after a near 50% pop in the session, as Roaring Kitty schedules a live stream later today.
Morning, young man. How are you?
Good, man. Yeah, no complaints. Never complaining. Doesn't help, especially on a Friday.
Absolutely. I like the positive attitude as well. What an exciting day ahead we've got. We've already had some interesting data. We've had the most expected rate cut in the history of rate cuts yesterday. Doesn't necessarily put any pressure on the US or the UK to follow suit. In fact, they almost certainly won't follow suit in this month as well. But still adds an interesting context. So who's cut now? The Canadians, the Swiss, the Swedes and the ECB as well. But on the other side of the globe, maybe we should focus on this as well, because I think the Chinese export data was very interesting. Look, these were really good figures until you looked at the middle column there as well. But I'll just go through this. Chinese export growth roared past estimates in May in US dollar terms, coming in 7.6% higher on the year versus 6% growth that Reuters had penciled in, showcasing a rate of expansion more than 5 times higher than in April. Now, the country's trade surplus with the US, now this is contentious though, widened to more than $30 billion as import growth came in well below expectations. I wonder if that will become more of a political hot potato stateside as we build up to November. Anyway, it was up 1.8% on the year. I think we've already covered a few of the points here. Yeah. Great on the export figures. What does the uninspiring import figure say about demand domestically, or is it a lens also on the manufacturing activity, which would then export again? So you can't just say imports were underwhelming. It's a domestic story because, of course, a lot of those imports are primary goods, which can be then used in manufacturing and industrials as well. I do think that subsector, and that's why I'm really pleased the producers put that in about the US widening. I'm afraid to say that's only going to add to the contention stateside and potentially in Europe as well about the concern that there are certain high-value goods now. It's not just cheap goods anymore. It's these high-value goods which are going to the Eurozone area, that are going to the United States and elsewhere, and are actually beating domestic competition.
I suppose on the one hand, one looks at that and then says, well, if imports are that low, of course, pricing is a different matter here to kind of look at. But how much of that is inflation bound as well? How much? And the question then becomes, to the rest of the world, they'll ask themselves, just like Janet Yellen did just earlier this year with those exports, that China shouldn't be exporting that inflation that they've always been talking about, right? And that then becomes very key with a surge in those exports. How much of that then is impacting the rest of the world
I think
inflation.
you raise a really, really important point. It's one we're going to raise with Bob Parker at the moment, who's been to China more times than I've had hot dinners, honestly. And we'll do that with him in a few moments' time. But China has historically exported deflation.
Yeah.
Now, though, with inflation watch so acute globally from the central bankers,
Exactly.
is it going to be exporting deflation, or actually because of the resumption of activity economically, is that going to be inflationary for actually resources, which is one of the supply factors which is so concerning to the central banks?
And one could argue that they need to raise their exports, right? Considering how
raise the
weak
exports,
demand.
but the price of those exports is very interesting.
Exactly.
Because a lot of them, dare I say it, whether it's solar panels, other renewables, and certainly EVs, are way cheaper than the European and US alternative in many cases. What about these markets?
Well, you can see some red there on the Asian market front then, specifically. In fact, you're seeing the Australian market managing to find some gains of around 0.4% higher. In fact, there's some gains then that you're seeing in that Hang Seng index, and it's actually still the tech stocks that you are seeing in the data. Of course, you're seeing a down day across that 0.4% then across Asia. We are speaking about the data. It was that May exports beating expectations. Japan also released its household spending figures for the month of April. That is actually important as well for the central bank, the Bank of Japan there. Average monthly consumption expenditure per household rising 3.4% in nominal terms. What does that mean then for the currency as well as the picture here? Pretty much flat stance right now for dollar yuan, 724.54.
Right, so many things to ask Bob Parker, Senior Advisor, the International Capital Markets Association. Bob, lovely to see you. Thank you very much indeed for getting up early and getting dressed. Well, at least your top half is dressed for us as well. I'm sure you're wearing silk-lined slippers underneath as well, but I don't need to know that. Tell us, let's start off on this Chinese data as well, because as I said in the introduction, you know far more about this country than I will ever know as well. How do you read the data, sir?
Well, I think the first point on the exports is that, yes, as you said earlier on, they are better than the consensus forecast. But that's against a background of actually quite weak data 2 to 3 months ago. So I think the first point is that month to month, the data are erratic. Having said that, the trend, I think, on export data is improving. The trend on manufacturing data is improving. However, the problem with the Chinese economy is that domestic demand remains weak. Retail sales, last month, year on year, were only up 2.3%. And although they came out, I think, with a very substantive fiscal package last month to try and underpin the real estate market, if you look at real estate equity prices, if you look at activity in the real estate market, it is going to continue to be very much a long haul to resolve the problems in the real estate market. So the good news is the IMF have upgraded their forecast for Chinese growth to 5% this year. I think there's a serious risk, actually, that the IMF are being too optimistic. And I think there's a very high probability year-on-year growth in the second half of this year probably comes out of 4.5%. And that's mainly an issue of weak domestic demand. And coming back to your earlier discussion about, exports and potential tariff issues, I don't think that problem is going to go away. And unfortunately, I think we are going to see increased trade tension between China, the US, and Europe over the next 6 months.
Yeah, I'll park the tariff concern for a while, because I think that's still to come, and we'll certainly get you on when Europe has its response on EVs and when the US ratchets its up again on that front. But I do want to ask you about the Chinese consumer, which you alluded to just there as well. I don't think they're stupid by any way, shape or thing. I think they're very smart people, the Chinese consumer. They've seen what's happened to them in the property market. I don't believe it's a question necessarily of not being able to access debt, from my understanding. It's a question of not wanting to access that debt, i.e. some form of Richard Koo type balance sheet recession, as typified we saw in China in the 90s as well. Is that your reading, Bob, that actually the Chinese consumer, without a social safety net, with potential ramifications from the middle income trap, as alluded to by the likes of George Magnus, just doesn't want to access more credit rather than can't access it?
Yeah, I think the availability of credit is not a problem for the household sector at all, as you say. And if you look at the Chinese savings ratio and data on consumption trends, I think it's very clear that the Chinese consumer is being very cautious at the moment. And I think they're cautious, one, because there is some concern about unemployment. There is obviously concern about the lack of a welfare or social security and pension net. So that is an issue. I think that the Beijing actually has an issue. It needs to, having tried to reboot the real estate market, and I think that's still very much work in progress. I think the next stage of Chinese policy making is probably to try and boost consumer confidence, and that today is the weakness in the Chinese economy. The weakness is not manufacturing or the export sector. If anything, they've been pushing the export sector too hard.
Bob, but I mean, one thing that certainly happened is that the Chinese authorities have not wanted to necessarily boost consumer confidence, whether it be by way of salary increases or anything of the like, because of just the regime and how that economy sort of operates. How difficult would it then be to kind of get that spin right, to get a shift in consumer confidence?
Well, if you go back to the COVID period, obviously there were a number of fiscal measures, to try and subsidize consumer spending. I don't think they're going to do that again. And let's not forget that if you add, central government debt and local government debt, the Chinese budget deficit is actually very significant. And some data points to a budget deficit, of close to 6% of GDP. So to answer your question, I think the sort of consumer subsidies that we have seen in the past are not going to happen. Having said that, I do think interest rates, but from PBOC, probably come down again, although they've been very cautious in their monetary policies so far. But I think an easing in monetary policy. I think one of the key factors here is what happens to the real estate market. And as I said earlier, I think that's work in progress. Having said that, I think the worst is past us on the real estate market. If we do get some pickup in real estate prices, I think that's going to have a very strong positive effect on consumer spending. But that hasn't happened yet. That may be down the road.
Bob, we always love having you on the show, so much so that we're going to keep you around for another chat after this short break. So do stay with us. Bob Parker, Senior Advisor there for International Capital Markets Association. Coming up on the show, though, US eyeing the non-farm payrolls data. That's out later today as investors look for any signs of the labor market cooling. We'll discuss more next. Plus, France makes a pledge to send fighter jets to Ukraine and train fighters on French soil. We'll have more later this hour. And don't miss our interview with the CEO of Okta. We'll discuss cybersecurity as well as his outlook for Europe's technology market. That interview is coming up at 8:15 CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
The best advice I can give someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
Now look, if you've watched this show for the last 20 years, you'll know I get mildly excited about all data, but especially excited about the non-farm payroll. The problem is I don't want to douse my own excitement, but it's not that it doesn't matter today. It's the fact that even if there is an outlier of a figure, say no growth or 400,000 jobs created, it ain't going to move the needle on its own. It would need a confirmation in subsequent data in either direction, which we're not seeing at the moment, because every time we see a good bit of data, we see a hard bit of data. Every time we see progress on the jobs, we see a pullback on it. So it's not about today's number. It's about if today's number represents a broader trend. The Fed would need to see 2, probably 3 months of trend before they move. So I don't want to douse your excitement, everybody, but that is the case. Let's be brutally honest about it, regardless of the knee-jerk moves on the stock market thereafter. Anyway, we are counting down to today's all-important jobs report. Investors looking for any signs the labour market is cooling after Wednesday's softer than expected ADP. It was mildly soft, as was the jobless stuff. I mean, I'm telling you, it's a glacial pace of softness. It's barely noticeable. Anyway, non-farm payrolls are seen remaining resilient at 185,000, up from 175,000 in April, according to economists polled by Reuters, with unemployment and earnings growth expected to hold steady. Now, I mentioned the US weekly jobless claims. They rose to 229,000 in the week beginning June 1st. That is the highest level in 4 weeks. All right, that sounds... just take a moment. I hope I'm not taking a moment out of Bob's time, because... He's worth a long chat on this. But look, it rose to 229 from 221 the previous week. The 4-week average, listen to this, the 4-week average is now 222,000 versus, 223,000 in the prior week. Modestly higher than 215,000 the week earlier. Look at this, continuing claims rose to 1.792 million, that is, isn't it? Well, from 1.79. The pace is glacial, Arrebile.
It certainly is, Steve. And a lot of that data is exactly what the Fed will be looking towards, right? As you've made note of, that trend, whether it actually is leading towards that softening in the economy, that then ultimately means they've done enough on that rate hiking cycle, now ultimately need to head a little bit lower. So those question marks certainly in play in this market. You saw a bit of a subdued trend across the day's trading, only the Dow Jones managing to lift itself higher yesterday. But you did see 8 of the 11 sectors actually move in positive trade then in yesterday's session, led by consumer discretionary, around 1% to the good there. But just for the week, right, just wanted to give you a sense here. The NASDAQ is up 2.6% this week. Again, Nvidia's near 6%, more than 6% surge this week has been quite important for that. Tech stocks themselves are up almost 4% this week. Yes, it does give nod to Nvidia, but let's not forget Meta as well as Amazon. Those are 5.5% up as well over the week. So significant gains as well, just for the NASDAQ composite, which had a benign downturn then in yesterday's trade. Overall, here's your treasuries picture then as well. Of course, we are headed towards that non-farm payrolls data point that Steve has also pointed towards then, which is very interesting. That unemployment rate anticipated to stay around that 3.9% figure. Let's just remember where we were as well, around 2 weeks ago on this 10-year note, right? 4.6 was pretty much where we were. And because of the data that has come out since, it has given out a sense that perhaps we are edging towards a rate cut, perhaps around September. At least 2 cuts have indeed been priced into this market so far. That 2-year note then having sat at nearly 5%, 4.7462. Your dollar crosses then, while the dollar's near an 8-week low ahead of that crucial US jobs report then. At the same time, the euro did hold on to the gains that it kind of had from yesterday. It rose around 0.2% on the back of the ECB having decided to cut interest rates for the first time since September 2019. 108.91 is euro dollar right now. Sterling pretty flat at this stage. We are seeing then perhaps a little bit of strength now for the dollar, but there was some strength in the yen having come down from that 156 mark that we saw early on yesterday, now 155.64. And out of Europe then, well, European stocks yesterday had that record close, right? The stock 600 hit an intraday record high. In fact, even closing just marginally above its record level then as well for it. All major bourses, most of the sectors pretty much trading in green. What was the biggest gainer? Well, tech, 1.2% higher, although healthcare did follow quite significantly as well. We look like we could have a little bit of a mixed open then in the trade, with the FTSE 100 anticipated to perhaps find some uptick. Now, we're speaking about the European Central Bank, and they delivered their much anticipated first rate cut since 2019, but said it will keep policy restrictive for as long as needed in order to tackle the persistent inflation. It reduced its main interest rate a quarter point to 3.75%. Now, that decision did come even as the central bank raised its forecast for inflation. It now sees inflation to be above that 2% target range until late next year. Interestingly, Robert Holzmann was the only governing council member to oppose that rate cut. According to Reuters, other hawkish members expressed regret at the explicit signaling of a June cut. ECB President Christine Lagarde said she could not commit to further easing.
Are we today moving into a dialing back phase? I wouldn't volunteer that, because as I said, we are making a decision on the basis of the confidence that we have that we are on a path. But we will need, at each and every point in time, in the course of the next few months, we will need data and more data and analysis of those data. I cannot confirm that it is the dialing process that is underway. There's a strong likelihood, but it will be data dependent. And what is very uncertain is the speed at which we travel and the time that it will take.
Bob Parker, Senior Advisor, International Capital Markets Association, still joining us. Bob, do you think that regret means that they wouldn't have actually cut yesterday had they not telegraphed that decision to cut so explicitly?
I think they would have cut. I think there's basically three observations. I think the first observation is that, inflation has come down a long way in the Eurozone. Now, let's not forget that inflation peaked, headline inflation peaked at over 10%. So I think there was a case for cutting. I think that's observation number one. Observation number two is that, however, I think, and you saw this sort of reading between the lines in Christine Lagarde's commentary, I think there was some regret, and I think regret's probably the right word to use, that ECB council members had been so explicit in signalling a cut at their June meeting. So I think that in future they are going to be a little bit more opaque about sort of what's going to happen to interest rates. And I think the third observation is that quite rightly they're not giving guidance on future rate cuts. I think it's very clear they're not going to cut at the July meeting, but investors are unclear today as to the number of cuts that we're going to see later in the year. And certainly there has been some reduction in investor expectations, and investors, if you look at futures markets and investor surveys, investors are now really only expecting one cut, and in extremis 2 cuts. So there has been this quite big change, in investor expectations. And obviously that comment applies equally to expectations as to what the Fed is going to do.
Yeah, but Bob, if you raise your inflation expectations then to sitting above 2% until next year, meaning you don't necessarily hit targets the whole way through, plus you've seen these PMI numbers still not necessarily sit in expansionary territory for a lot of the regions across Europe, there's still some massive weakness. So if you're going to begin cutting, but you're only going to do one, does that not affect credibility then for the ECB?
I don't think it affects credibility. I do think that, coming back to your comment about, the economic data, we are seeing an improvement in the Eurozone economy. And yes, a number of countries still have PMIs well below 50, but the service sector PMIs are relatively strong and the manufacturing PMIs are improving. And, if one quantifies that, we're probably looking at year-on-year GDP growth in the second half of this year above 1%. Now, obviously, that's still very low compared with the States. But it is, a much better number than what we were seeing, at the beginning of this year when growth was sort of trending close to zero. So we are seeing this slow improvement in Eurozone growth. Having said that, on the inflation side, inflation has come down, as I mentioned, but in this sort of zone of sort of plus or minus 2.5% inflation, the scope for inflation to come down further is frankly rather limited. And, one concern which Christine Lagarde actually talked about at some length is what's happening on the labour market, where unemployment in the Eurozone is at a record low, and where wages growth, the latest data shows wages growth, just under 5%. So I think the ECB is right to be cautious in terms of, how many cuts can be expected in the second half of this year. As I say, my central case is probably one cut, possibly 2 cuts.
Yeah, and literally as we are speaking, Bob, this morning, I'm seeing flashes about the CGT in France, and it's just another union, but just filing for strike notice in the electricity and gas sector as well. So if the unions feel confident enough to strike, then they must feel confident enough in their jobs as well. Quick word on the market reaction to everything we're seeing at the moment, and we can throw in the US in this as well. The US has been stunningly robust, perhaps wouldn't have been without the Nvidia-inspired rally. As rates remain stubbornly high there as well. Just to look forward to the payroll, Bob, and what it really and the ramifications of that today.
Well, forecasting error for monthly payroll numbers, as we all know, is very high, and and the forecasting industry has got a pretty bad track record in trying to analyse month-to-month figures. However, let's look at the trend, and the trend is, and you used the word glacial earlier on in the programme. The trend is that the labour market is starting to cool down, but at a very slow pace indeed. So, if one looks at the next 3 to 6 months, assume that monthly non-farm payroll numbers are going to be around 150,000. I think what's more important is what's happening to wages growth in the States and average earnings growth. And that certainly is moderating, and consumer confidence is weakening. So I think the critical point, which loops into US inflation, is that the US economy is probably now going to grow at sub 2% growth. It's not going to be sub 1.5%, but certainly the days of 2.5-3% growth, I think, are now behind us. That probably will allow the Fed to cut once in September, potentially another time later in the year. But I think that is generally sort of market supportive. If you look at catalysts which could trigger a major market reversal, I'm struggling to find those catalysts at the moment. So I think, in summary, I think that both Europe and the US equity markets, certainly we can hold these current high levels.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.